What is going on, everybody? Cole Simonson here, and today we are talking about my 3 favorite long-term investments. So stick around, you're gonna like them. They're super easy, super simple, and they have a opportunity to make you a lot of money in the long run. But before we get started, why don't you guys hit that like button? It really helps me and the YouTube algorithm out. And if you like this video, subscribe and hit the notification bell so you don't miss anything from me. Let's get started here with number 1. It's the easiest, simplest, and you pretty much just have to tell your employer the type of investments you want to make, and that is your 401k. Now, a 401k is a pre-tax investment, which means they take it out of your paycheck before taxes, invest it in your account, and they let that account grow and continue investing in it. When you hire on, there's an opportunity from a lot of people to choose your investment strategy or type. A lot of times there'll be like a safe, moderately aggressive, and aggressive investments that you can go into, and it just depends how you feel about it. Usually aggressive investments can make you a lot of money, but they can also lose you a lot of money. Safe can not make you a ton of money, but it is also safe, so it's pretty much guaranteed you're going to make a good chunk of change from it. Now, since the 401k is pre-taxed, the government's not that nice and isn't going to let you keep their money forever. So at 59 and a half, when you're able to start withdrawing this without a penalty, they will start taxing it at your tax rate, so you don't get away with no taxes. But that being said, it's also not taxed until you're 59 and a half and you start withdrawing it. The good thing about your 401k is usually your employer takes care of it and their investment companies take care of it. And if you're lucky enough, they offer a match, which is a certain percentage of what you make, and they'll match that a certain percentage. For example, if you make $50,000 with a 3% match, they'll put in $1,500 into your 401k. I like to max out my 401k as much as possible. That way, I'm investing as much as possible in that, and they're matching me a good chunk of change. Now, if you decide to take out of your 401k, say you need to pay some bills, or you want to pay something off before you're 59 and a half, there is a penalty fee from the IRS along with your tax on that withdrawal. So it's like a 10% penalty fee. You pay 10% plus the taxes on it, and then you get your money. So it is in everyone's best interest to keep it in there as long as possible, and especially try to keep it in there until you're 59 and a half. Then when you start withdrawing, you don't have to pay any penalty fees, just your taxes. On to number 2. Definitely one of my favorite accounts I have that makes me a really nice chunk of change is the Roth IRA. A Roth IRA is also a long-term retirement account, which is invested by you after taxes. So you pay taxes now, don't pay them later. This one is a little bit more difficult than 401k because you have to do it. You have to go to the brokerage or the bank and ask them to invest in a Roth IRA for you. A Roth IRA is very good when you're just starting off because they go on your current tax rate. So if you're at a low income, you're getting taxed less, and you're able to put in more or whatever you want to. Another really nice perk of a Roth IRA is you can withdraw whatever you put into without being taxed. So If you've put in $2,000 so far, you can withdraw that $2,000 and not have to worry about it. But if you try to withdraw what you've made, that can come with a penalty and be taxed again. That being said, it's just a monthly contribution. I put in like $200 a month. You can max it out to $6,000 per year if you want. Right now, I do not, because I'm investing other places that I feel can make me more money. But that is just me. A lot of people like to leave their investments alone and just let them grow, which is great. So I would max out my Roth IRA to be able to put in $6,000 a year. And once again, you cannot pull this out without a penalty until 59 and a half. But when you do, since you've already been taxed on it, it's yours. So those are just a couple of the benefits and the cons of a Roth IRA. And finally, number 3, long-term investment, and probably my favorite, is a dividend portfolio. Dividend portfolios are great in my opinion, especially if you're a little bit riskier person. They can make you a lot of money in the long run, and if you invest it right, you can be a happy camper and just live off of dividends when you start getting older and even retire. What a dividend is a certain amount of money the company pays out to shareholders every quarter. For example, you own 100 shares and the company decides to pay out a 50-cent per share dividend. That's $50 that they pay to you. So you can see, if you hold a lot of shares in companies that pay a decent dividend, that you're able to make a lot of money, and in turn you can even reinvest that money back into the company and continue growing your portfolio that way. The positives about dividends are they pay you to own the company. A lot of times it means that the company is a relatively safe company and they are taxed a little bit lower than other types of income. So there's pretty decent advantages to owning a dividend stock. A couple disadvantages are it is still a stock. Yes, it can go up and yes, it can go down. So you have to do your research on the company itself and make sure that they're going to be a growth company. There's a lot of companies out there that trick you or try to trick you and show that they have a high dividend yield, but that also means that their money's not going anywhere or being reinvested into the company. That gets on to my second point. Usually when companies start paying dividends, they don't know or they don't want to start expanding or know where to put that money, so they pay it to the shareholders instead of actually trying to grow the company more. So when you're looking at a really high dividend yield, try to stay away from those, the 7, 8, 10% ones, because the company doesn't really know what to do with their money, or they're trying to not expand. They're slowing down a lot. Also, the final risk is companies don't have to pay out a dividend. So if you are relying on a dividend every month or every quarter for them, or actually need a dividend and they stop paying it, then you lose out on your dividend money. And that's also a bad sign for the stock, because a lot of times that means they don't have enough money to pay the dividend, or they're losing money somewhere. But all in all 3 of those, as long as you do your research, are pretty safe and have a chance of making you a ton of money in the long run. Remember, I said long run. This is long-term investments. So be patient, watch it grow, and when you retire, you'll have a nice little nest egg. Thank you for watching. I'm Cole Simonson. If you haven't smashed the like button yet, please do. It helps me out and helps the YouTube algorithm out. If you want to hear more from me, subscribe and hit that notification bell so you don't miss anything. And tell me what you're doing with long-term investments below. See if we have the same ideas. I'm out of here. You guys have a great day.